We begin with the government's tax revision today, aimed at boosting domestic demand. It is determined to breathe new life into the nation's sputtering economy. The move will motivate companies to put the hoards of cash they've been sitting on back in the market. Myung-kil has our top story.
The Park Geun-hye administration is proposing a tax revision, putting pressure on large conglomerates to use their cash reserves on investments, paying out dividends, and raising the wages of their employees. Instead of hoarding that cash, the government would like to see it flow into households as a way to boost domestic consumption. Under the government's proposal for a tax revision that goes into effect next year, the government will provide a 5 to 10% tax deduction for companies that raise employee salaries, with extra incentives for firms that take additional measures. The dividend tax will be cut to 9% from the current 14% if dividend payouts meet certain targets. Companies with paid-in capital exceeding $48 million will have to pay a 10% tax on their total cash reserves for 3 years if they don't meet one of the two targets, spend 60 to 80% of their net profit on investments, salary increases, and dividends, or use 20 to 40% of their profits for salary increases and dividends. However, the idea of taxing the internal reserves of companies has not been met with kindly by the business community. They contend that many of the businesses have been setting aside earnings for a rainy day. Even if companies increase their dividends to avoid taxes on their cash reserves, they say the impact would not meet expectations for increasing domestic investment and consumption. Myung-kil, Arirang News.